Welcome to vTalkInsight, Allocator's Lens Daily for April 10th, 2026. Across assets today, the key tension is between an entrenched energy shock and sticky inflation on one side, and remarkably resilient risk appetite on the other. Let's start with equities, where that clash between macro risk and earnings strength is most visible. In equities, headline resilience remains striking given the macro backdrop. The S&P 500 has logged 7 consecutive daily gains and now sits only a few percent below its all-time high, even as oil remains elevated and Middle East tensions persist. Volatility has eased back, with the options base fear gauge moving down toward the high teens, signaling that markets are again comfortable leaning into risk. That resilience is underpinned by powerful earnings dynamics. Forward profit estimates for the S&P 500 continue to grind to new highs, and consensus still looks for around 16% year-on-year earnings growth both this year and next, despite higher input costs. AI-linked technology and energy now dominate index-level earnings, with cloud and semiconductor names benefiting from over $1 trillion of committed AI infrastructure spend, multi-decade contracts like Meta's agreements with CoreWeave, and renewed momentum at firms such as Intel. Structural flows matter as well, with steady buybacks, retirement contributions, and allocations from wealthy households providing a persistent bid that makes equities somewhat less sensitive to short-term economic data. Beneath the index-level story, though, the picture is far more nuanced. Recent gains have been driven heavily by systematic flows and the largest bout of hedge fund short covering in more than 4 years, while many widely held stocks are still down 20 to 30% from their highs. Companies exposed to higher fuel and electricity costs are already seeing margin pressure, and analysts warn that if energy inflation broadens, the ability to pass on costs without hurting demand will be limited. Consumer and staple sectors look particularly vulnerable in scenarios where oil sustains around $100 or higher, while European software is contending with new competitive threats from fresh AI model launches. The stagflation debate is critical here. Some macro views still see U.S. growth running near 2% with inflation in the low threes, but others expect growth to slow toward 1.5% while inflation drifts closer to 4%, which would be more challenging for earnings multiples. Small and mid-cap stocks sit at the intersection of these forces. They have historically fared better in periods of higher nominal growth and strong energy and industrial activity. Yet today they are also highly sensitive to the prospect of no rate cuts or even renewed hikes, given elevated refinancing needs. Allocators are therefore emphasizing selectivity, favoring less leveraged cyclicals tied to U.S. capital expenditure, while remaining cautious on highly indebted names that could suffer most if the energy shock persists. Regionally, U.S. indices still look relatively insulated, whereas European benchmarks are more exposed to fuel costs and banks, and Asian markets in Taiwan and Korea remain supported by structural winners in chips and turbine manufacturing. Turning to rates, pricing increasingly reflects a higher for longer stance on policy and inflation. Current analysis ranges from a soft landing scenario with inflation around 3 to 3.5% and growth above 2, to a stagflation skew where growth slows toward 1.5% while inflation pushes toward 4%. Inflation-linked derivatives now imply U.S. inflation above 3% even out to 2027. And the central bank has missed its 2% core inflation goal for 5 consecutive years, which together suggests markets believe the de facto target has drifted higher. Recent policy minutes reinforce that message. Within the Federal Reserve, some officials are now openly prepared to raise rates again if energy-driven inflation stays elevated, while others focus on downside risks from a protracted Middle East conflict and would consider cuts only if the labor market weakens meaningfully. In Europe, expectations have swung from a gentle easing path toward the possibility of rate hikes over the next 2 years, as investors reassess the inflation impulse from energy and limited fiscal capacity. On the curve, oil price shocks are driving long-dated yields higher rather than lower, as concerns over persistent inflation and large fiscal deficits outweigh traditional flight to safety dynamics. 10-year treasuries no longer offer the same defensive ballast, and some see greater relative value in the front end, where carry is less exposed to term premium shocks. At the same time, 30-year inflation-linked bonds now yield around 2.7% in real terms, offering a notable alternative to gold for those focused on long-term inflation protection. With another key U.S. inflation print imminent, Rates remain the main transmission channel through which the energy shock can reprice all other assets. Credit markets show a split personality. In public markets, demand for corporate bonds is exceptionally strong, with record issuance in March and frequent oversubscription for both investment-grade and high-yield deals, including longer-dated and convertible structures. Investors are increasing fixed income allocations on the view that policy rates are broadly on hold, and some portfolios are selectively adding high yield, where overall yields exceed 7%. Spreads remain tight by historical standards, signaling confidence in near-term corporate profitability. Yet that tightness looks increasingly out of sync with underlying credit risks. Higher energy costs, slower global growth forecasts, and rising refinancing needs all point to more differentiation ahead. Several allocators now argue that current spread levels underprice the possibility of wider defaults in weaker sectors and expect a gradual increase in selectivity and some widening as market realities catch up. Company-specific stories, such as Oracle's wider credit spreads and efforts to syndicate large data center financing, underline how capital-intensive AI projects constrain even household technology names. In contrast, private credit is already under visible stress. The roughly $1.8 trillion market is seeing record redemption requests, particularly in perpetual business development companies, where some vehicles face demands of 15 to 40% of assets. Opacities that once dampened volatility are now amplifying concerns, prompting a wave of withdrawal requests just as returns decline due to lower floating rate income and narrower spreads. Moody's has turned negative on the sector, highlighting stretched leverage, heavy exposure to asset-light software businesses with potentially low recovery values, and over $330 billion of related debt maturing by 2028, with forecasts of double-digit default rates in that niche. How this private stress interacts with still buoyant public spreads is a key question for multi-asset portfolios into year-end. In foreign exchange, the dollar remains the central anchor of the system, but its behavior in this crisis looks different to past episodes. Despite repeated geopolitical shocks, the haven bid into the greenback has been noticeably weaker, with safe haven flows more dispersed. Some investors are gradually diversifying toward emerging market fixed income and equities, motivated mainly by diversification rather than by belief that an alternative reserve currency is imminent. At the same time, the Swiss franc is again attracting safety-seeking inflows, supporting Swiss asset valuations even as the stronger currency complicates the domestic growth outlook. Energy prices are exerting a powerful influence on currency dynamics. The Japanese yen remains under pressure, with high import costs keeping the exchange rate near historically weak levels around the high 150s against the dollar, just as Japanese consumer confidence suffers its steepest decline since the pandemic. In Asia more broadly, options activity shows renewed interest in the Korean won and the Chinese yuan, with the won rebounding and the yuan holding firm in the wake of earlier ceasefire hopes, signaling that investors are willing to add selective Asia FX risk when geopolitical headlines calm. From an allocator's standpoint, the path of oil and gas prices and the degree to which the dollar's haven premium remains muted will be central drivers of cross-border returns. Commodities remain the fulcrum of the entire cross-asset narrative, with oil at the center. Shipping through the Strait of Hormuz is still severely constrained, with only a handful of vessels departing amid security concerns, new tolls, and the need for military escorts. Estimates suggest more than 10 million barrels per day of production have been disrupted, potentially rising toward 13 million, while Russian output is also lower, leaving global supply extremely tight. Asian buyers have been aggressively sourcing barrels from the Atlantic basin to compensate, which in turn sets Europe up for potential shortages as its buying cycle ramps up. This stress is most obvious in physical pricing. Benchmarks for near-term delivery, such as Dubai and dated Brent, and actual cargo trades are printing well above levels implied by contracts for later delivery, with some physical barrels changing hands above $120. A pronounced premium for prompt crude signals acute near-term scarcity and intense competition for available supply, while tanker rates have surged, as highlighted by the dramatic rise in shipping-related equity vehicles. Analysts warn that if Strait disruptions persist for another month, oil could spike to around $100 or more, with each additional month potentially adding $15 to $20, given critically low inventories and limited spare capacity. Those price levels carry clear macro implications. Higher oil is inherently inflationary, lifting nominal GDP and putting upward pressure on interest rates, particularly if real activity remains resilient in the short term. But with consumers in the U.S., Europe, and Japan already reporting affordability strains and declining confidence, there's a rising risk that sustained triple-digit crude eventually forces demand destruction and weighs on corporate earnings, especially in consumer-facing and travel-related sectors. Markets may be underestimating the odds of a prolonged conflict and the resulting risk premium that could permeate not just energy but broader asset prices. Beyond oil, traditional inflation hedges are also back in focus. Central banks have been major net buyers of gold since 2022, to the point where aggregate bullion holdings now exceed their treasury positions, underscoring a strategic shift in reserve management. Gold miners have offered substantial leverage to that trend, with some names delivering multiples of the underlying gold price over recent years. Industrial metals are also in play. Tighter aluminum supply linked to Middle East disruptions has prompted upward profit revisions for producers such as Alcoa, reflecting how the energy shock is feeding into broader materials markets. Together with long-dated inflation-linked bonds, these commodity exposures are shaping how allocators think about hedging both inflation risk and potential policy mistakes over the coming cycle. Stepping back, the cross-asset picture is one of tension between resilient risk assets and an increasingly stagflationary skew in the macro data. Equities remain buoyant on strong earnings and powerful AI and energy themes, even as higher fuel costs threaten margins and consumers over time. Rates markets are converging on a higher-for-longer narrative, with a long end reflecting both persistent inflation and fiscal strain, while public credit stays well bid and private credit quietly absorbs rising redemption and default risk. In currencies, the dollar's haven role looks less dominant. The yen remains pressured by energy imports, and the Swiss franc and selected Asian currencies are absorbing more of the shock. Commodities, led by oil and gold, continue to anchor the distribution of outcomes for inflation, growth, and ultimately policy. For allocators, the key watch points from here are the next U.S. inflation release, any substantive change in the Middle East conflict and shipping constraints, signs of consumer fatigue in high energy price economies, and the trajectory of stress in private credit. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.